What if I told you that one of the most iconic software companies in the world, a business that powers virtually every creative professional on the planet, is trading at its cheapest valuation in over a decade? Welcome back to my Applied Stock Investing channel. Today, we are going a deep dive into Adobe. This is a full investment research breakdown. We are going to cover everything: the business model, the return on equity, the PEG ratio, the PEGY ratio, and most importantly, the downside risk that you need to know before you think of investing in this company. And before we go any further, this is not a financial advice, this is purely educational research. Please do your research before making any investment decision. Most people know Adobe as the company behind Photoshop, and that's fair. Photoshop is basically synonymous with photo editing. But Adobe is much more than that. It's actually a sprawling cloud software empire split across three core segments. The first, and by far the largest, is the digital media. This is Creative Cloud, Photoshop, Illustrator, Premiere Pro, After Effects, Lightroom, basically the entire toolkit that every designer, photographer, filmmaker, and content creator on the planet uses. This segment alone generated $17.65 billion in revenue in the fiscal year 2025. The second is the digital experience. This is the Experience Cloud, the enterprise facing side of Adobe. Think about marketing analytics, commerce platforms, customer journeys, orchestration. The big Fortune 500 companies use this to run their entire digital marketing operations. That brought in $5.86 billion last year. And third is Document Cloud, the Acrobat PDF tools, e-signatures, and the new Acrobat AI assistants. This sits within the digital media segment, but it's worth calling out separately because it's growing very, very fast. In fiscal year 2025, Adobe posted a record revenue of $23.77 billion, up 11% year over year. Total annual recurring revenue, it was around $25.20 billion. The operating cash flow was over $10 billion. But this is a big but. The stock is down 40% over the past 52 weeks. So what's going on? Why is such a fundamentally strong business being punished? That's exactly we are going to unpack today. So what does Wall Street actually think about Adobe right now? At the time of the recording, out of 22 analysts covering the stock, only 14% have a strong buy rating. 27% are at buy and 45% of analysts are sitting at hold. Now compare that to a year ago when 72% of analysts were bullish. That's a massive shift in the investor sentiment. It's completely driven by the fear of AI disruption. We are going to come back to that detail when we talk about risks. The ticker base case model values Adobe at $392 by 2030. That's roughly 63% of total returns from the current market price of 220. So we can conclude that there is a limited near-time downside and a meaningful long-term upside. But nobody wants to commit until there is more clarity on the AI story. That's a fascinating setup, and that's exactly why this company is worth studying carefully. Now, let's get into the financial quality of the business. One of the first questions I ask about any company is how much capital does it need to invest just to keep the lights on and grow? Because a business that needs to spend 20 or 30 cents of every revenue dollar on physical equipment, maintenance, and infrastructure is very different from the one that barely spends anything. Adobe is in the second category. In fact, it's almost a textbook example of what investors call a capital light business. Look at this first number. Adobe spends approximately 1.2% of its revenue on capital expenditures. 1.2%. For context, a typical manufacturer or a telecom company spends anywhere between 10 to 20% of revenue on capital expenditure. An oil and gas company could spend almost 25 to 40%. Adobe is spending a tiny fraction of what most industries need. Why? Because software is written once and delivered to millions of people At near zero cost, there are no factories, no raw materials, no trucks, no warehouses. About 97% of Adobe's revenue comes from subscriptions. And that model means every new customer added is essentially pure profit at the margin. Now look at the second number, a free cash flow margin of approximately 41%. That means 41 cents for every dollar. That's genuinely extraordinary. The bar chart on the left tells the growth story. A free cash flow went from 6.94 billion in 2023 to almost 9.85 10 billion in financial year 2025. That's 40% growth in free cash flow in just 2 years. But still, the stock has been failing. This is an important disconnect we need to hold on as we go through the rest of the analysis. Return on equity. Return on equity shows how much profit a company generates for every dollar of shareholder equity. The higher it is, the more efficiently the business creates value. For perspective, the S&P 500 averages around 15 to 18 percentage. Microsoft is around 35 percentage. Adobe is an incredible 61 percentage. The chart tells the story. Return of equity was about 40 percentage in 2020. It dipped, and then in 2025 it was almost 61 percentage. A jump in 2 years. But is that just because of share buybacks? A good question. Buybacks can inflate the return of equity by shrinking the equity base. That's why we check the return of invested capital. Adobe's return of invested capital is an equally impressive 63%, confirming that the returns are driven by the business, not by any financial engineering. You just add in 89% gross margins, and it's clear that why Adobe is considered one of the highest quality capital light business in the market. Now for the most surprising part of the analysis, the valuation. PE ratio tells you how much investors are willing to pay for each dollar of earnings. The higher PEs usually reflect higher growth expectations. Adobe's current PE is just 14. Now compare that to its own history. Its 3-year average is 37, 5-year is 39, and 10-year average is nearly 45. That means Adobe is trading at about 69% discount to its historical valuation. If the market simply valued Adobe at its long-term average multiple again, the stock would roughly triple at today's earnings. The peer comparison is just as striking. Adobe has the lowest PE in the entire group. Microsoft trades at 25, Salesforce at 22, Autodesk at 45, and ServiceNow nearly 65. Looking ahead, Adobe's forward PE is only 10.5 versus an industry average of 18.3, about a 42% discount. Of course, a low valuation isn't always a bargain. Sometimes it's a warning sign. The market may be pricing in slower growth, and we will cover those risks next. But based on the numbers alone, Adobe is trading at one of the cheapest valuations it's seen over a decade. The PE ratio only tells part of the story because it ignores growth. That's why investors use the PEG ratio, popularized by Peter Lynch. It simply divides a company's forward PE by its expected earnings growth. A PEG below 1 is generally considered undervalue, around 1 is fair value, and above 2 is expensive. Using Wall Street's forecast of 13% EPS growth and Adobe's forward PE ratio of 10.5, Adobe's PEG comes to just 0.81. That's the standout result. Adobe is the only company in its peer group with a PEG below 1. ServiceNow at 1.26, Microsoft at 1.65. On a growth adjusted basis, Adobe is the cheapest stock in the group. Adobe also doesn't pay a dividend, so that's why PEGY is the same as 0.81. And if you factor in the massive 25 billion share buyback, some analysts would argue its effective PEGY is well below 0.5. Even if earnings growth slowed to just 8%, Adobe's PEG would rise to only 1.3, still lower than Microsoft today. The valuation looks remarkably cheap, creating an opportunity for us. Now let's think one step ahead. What could go wrong? The second order of thinking. I've identified 9 key risks, but here are the biggest ones. First, AI disruption. This is the existential risk. Tools like Midjourney, Runway, Stable Diffusion can generate professional quality content without opening the Photoshop. If AI makes creative work cheaper and easier, Adobe's premium subscription model will come under pressure. Second, the leadership uncertainty. The CEO Shantanu Narayan, who transformed Adobe into a 25 billion subscription business, is stepping down. There is still no named successor, creating uncertainty at a critical point in Adobe's AI transition. Third, the rising competition from Canva, Figma, and now Claude Design are growing much faster than Adobe and winning over students, freelancers like me, and small businesses. The next generation of Adobe customers are inclined towards the competitors of Adobe. Beyond that, Adobe's 2026 revenue guidance is generally muted. It is going to be very flat. These are real concerns. But the key question is, are they already priced into a stock trading at just 14 times earnings? We have covered both the bull and the bear cases. Now let's look at the risk versus reward. In the bear case, where AI slows growth, Adobe trades at just 10 times earnings, the stock could fall to around $170. In the bull case, simply reaching the average analyst target implies 36% upside, while the long term valuation model points to $392 by 2030. So, on paper, the risk reward still favors the upside. The downside is also supported by three factors: a 10.5 forward PE, which already reflects a lot of pessimism, a 25 billion share buyback showing management's confidence, and over 10 billion in annual free cash flow, giving Adobe the plenty of flexibility. The biggest concerns remain leadership uncertainty, intensifying competition, and above all, the AI disruption. Ultimately, Adobe passes almost every quantitative test: exceptional returns, industry leading cash flow, lowest peg in its peer group, and one of the cheapest valuations it's traded in years. The investment case comes down to one question: will AI strengthen Adobe's moat or destroy it? If Adobe successfully integrates and monetizes the AI, today's valuation could look like a bargain. If AI commoditizes creative software, even a low PE may not be cheap. That's the decision every investor has to make. Bring everything together with a quick scorecard or my checklist. Adobe's fundamentals are outstanding. Revenue grew 11%, operating cash flow hit a record 10 billion, and free cash flow margins are an industry leading at 41%. It's an incredibly capital efficient with capex at just 1.2% of revenue, while return of equity exceeds 60%. Adding an 89% gross margin, you are looking at one of the highest quality software businesses in the market. On valuation, Adobe stands out even more. PEG and PEGY ratio proves to us that it is one of the cheapest stock. Meanwhile, annual recurring revenue has grown to a 25.2 billion, showing the subscription business remains strong. The concerns are equally clear, showing analyst sentiment as weak, an upcoming CEO transition, and uncertainty around AI driven competition. So here's the takeaway: Adobe combines exceptional fundamentals with meaningful risks, but much of that uncertainty already appears to be reflected in the today's stock price. Let's wrap this up. So the investment case comes down to one question: is the market overreacting to the AI risk, or is it correctly pricing Adobe's future? I've shared the data and my checklist for this research now. This is not a financial advice to buy or sell. Please do your own research. If you found this analysis helpful, Please like the video, subscribe for more deep dives, and let me know in the comments, are you buying, watching, or avoiding Adobe? Thanks for watching.